In 2021, Wall Street was obsessed with a financial product that promised to make everyday investors rich by finding the next Tesla. They were called SPACs, or blank check companies, and they took companies like Virgin Galactic and Lucid Motors public, creating a massive speculative frenzy. A year later, most of them had collapsed, wiping out billions in retail investor wealth. What happened? Was it just bad luck? Or was the game rigged from the start? Today, we're dissecting this SPAC trap. Welcome to the Microcap Brief. A special purpose acquisition company, or a SPAC, is essentially a publicly traded pile of cash. Investors give money to a management team known as the sponsor, who then has about 2 years to go on a treasure hunt to find a private company to merge with and take public. It sounds exciting, but the structure of this treasure hunt contains 3 fatal flaws that made it a trap for most investors during the boom. Flaw number 1, the ticking clock. The SPAC sponsor has a 24-month deadline to find a deal. If they fail, the SPAC liquidates and they lose their entire initial investment. This creates immense pressure to get a deal done, not necessarily a good deal done. Think of it like a game show where you have 60 seconds to pick a door. As the clock ticks down, you're more likely to just pick any door rather than carefully inspecting the prize behind it. This pressure to avoid a total loss for the sponsor means due diligence gets rushed and questionable companies get a fast pass to the public markets. Flaw number 2, the hype loophole. Historically, the SPAC process had a huge regulatory loophole. In a traditional IPO, a company is legally restricted from making wild, forward-looking promises about future revenue. But SPACs were able to use a legal safe harbor to present incredibly optimistic multi-year financial projections. This allowed pre-revenue companies to market themselves with hockey stick charts of future profits, fueling a hype cycle based on a story, not on a real business. This is exactly how a company like Nikola was able to go public. The SPAC process allowed them to sell a story of revolutionary technology that would have faced much greater scrutiny in a traditional IPO. It's important to note that the SEC has recently closed this loophole with new rules in 2024, but the damage from the boom years was already done. Flaw number 3, the sponsor promote. This is the most critical flaw, and it's where the game is truly rigged. The SPAC sponsors, the management team, are traditionally rewarded with a 20% stake in the company, known as the promote, for a tiny nominal investment. This creates a massive conflict of interest. The sponsor's success is not tied to the long-term performance of the stock. Their goal is simply to get a deal done. Any deal. The math is staggering. If a SPAC stock collapses by 80% after the merger, a retail investor who bought in at $10 loses 80% of their money. But because the sponsor got their shares for practically nothing, they can still walk away with a profit of tens of millions of dollars. It's a structure that essentially privatizes profits for the sponsors while socializing losses to the public. It's a classic heads I win, tails you lose scenario. These 3 flaws created the perfect storm for the 2021 collapse. We saw it play out in famous examples. Virgin Galactic, SPCE, a brilliant, futuristic story of space tourism that was not yet a real business. The stock soared on the promise of a new space age, but collapsed as the immense operational realities, technical challenges, and delays set in. Lucid Motors, LCID, positioned as the next Tesla, it went public with a massive valuation based on aggressive production targets. But as any auto executive will tell you, mass-producing a car is one of the hardest things in the world. When the company inevitably hits supply chain and manufacturing hurdles, the stock plummeted. So is there any way to spot a good SPAC? The professional consensus is clear. Ignore the target company's hype and focus exclusively on the quality and track record of the SPAC sponsor. Reputable sponsors, often from established private equity firms, have their long-term reputation on the line. And in what some are calling SPAC 4.0, the market is evolving. We are now seeing more high-quality sponsors who structure their promote to be performance-based, meaning they only get paid if the stock performs well for all shareholders, creating true alignment. They are tying their own success to yours. Your key takeaway is this: the SPAC boom was fueled by a flawed structure that incentivized speed and hype over quality and diligence. While regulators are now cracking down, the fundamental risks remain. If you ever consider investing in a SPAC, your research shouldn't be on the shiny new company they plan to merge with. Your research should be a deep, forensic dive into the history, integrity, and most importantly, the incentive structure of the sponsors themselves. Ask yourself, are they in it to make a quick buck, or are they in it to build a real long-term business? Thank you for listening to the Microcap Brief. Do your own research and invest wisely.